big changes, really big changes in available petrochemical capacity are coming. The Petrochemical Weekly Update starts now. The U.S. Energy Information Administration reported yesterday that U.S. energy trade lowered the 2020 U.S. trade deficit for the very first time on record. This chart from the EIA shows U.S. net merchandise trade value from 1975 through 2020. In 2020, the value of energy products, that is the petroleum, natural gas, coal, and electricity exports, less the value of their imports, was a positive $27 billion. This is the very first time that the value of U.S. energy exports exceeded the value of imports since the U.S. Census Bureau started tracking this data in 1974. And the trend is continuing. In the first 3 months of 2021, the net trade value of energy was at a surplus of $9 billion. In the second chart from the EIA, you can see the net energy trade value balance over the same period. Here you can see the petroleum accounts for the vast majority of energy trade. In fact, 92% of imports and 74% of exports in 2020. You can see that the energy trade value deficit peaked in 2008 and has been trending upwards ever since. In 2020, the petroleum net trade deficit was $3 billion, the smallest deficit on record, and partly due to reduced consumption during the COVID-19 pandemic. In the EIA's short-term energy outlook, they forecast that imports of petroleum are going to outpace exports in the years 2021 and 2022. The trade surplus is going to come from exports of natural gas, in particular LPG going to Mexico. For your information, coal and electricity are part of the index but are relatively small contributors to this calculation. So, you may be wondering, what do shifting energy trade balances have to do with petrochemicals? Well, the Petchem Global Market Intel Advisory, delivered to you by Petrochemical Strategies and supported by IIR Energy and powered by i2 Enabled, can help. If you have questions and want answers, just ask me. You can reach out to me directly through my website or to the IIR Energy team. Both addresses are listed on your screen. Let's take a look now at the global capacity developments in petrochemicals over the last week and what we can expect by the end of this week. What you see here is the PCGMI Start of Day dashboard. I can select petrochemicals, then product make to drill into the details for integrated refining and petrochemical manufacturers' available capacity. From the week-on-week table, I can see what happened last week, this week, and what to expect by the end of the week. Over the past week, we saw increases in available capacity in Asia, Europe, and Russia. In Asia, there were several facilities with available capacity decreases, as well as several facilities that came back online. In Europe, the big change was due to the restart of Shell in Germany. By the end of this week, decreased available capacity at Star Petroleum Refinery Company in Thailand and the outage at Qatar Petroleum are the most significant changes we're going to see in Asia. In North America, the story is all about restarts in Louisiana, including Nova Chemicals, Shell, Dow, Shintech, and Valero, collectively adding 29 million pounds a day of available capacity. Let's look at the headlines. Shell Enterprises, a US-based subsidiary of Royal Dutch Shell, announced earlier this week it had agreed to sell its business in the Permian Basin to ConocoPhillips, who are already a leading developer in the area, for $9.5 billion in cash. Industrial Info is tracking more than $13.6 billion worth of oil and gas production projects in the Permian Basin, as well as 19 plants in the area that are owned or co-owned by Shell, Chevron, or their subsidiaries. China's crude oil output exceeded 17 million metric tons in August. That is a 2.3% increase from August 2020 and a 4.7% increase from August 2019, according to an announcement made last week from China's National Bureau of Statistics. From January through August, China's crude oil output exceeded 133 million metric tons. That is up 2.4% from the same period last year and 4% from the same period in 2019. And finally, in the news, INEOS announced that they plan to spend £1 billion, or almost 1.4 billion US dollars, to reduce greenhouse gas emissions at their facility in Grangemouth, Scotland. Their target is to get to net zero by 2045. This is on top of a commitment to spend almost £500 million, or $700 million at the site. Stuart Collings, CEO of INEOS O&P UK, is quoted as saying, "Hydrogen will play a very important role in the decarbonization of our manufacturing plants." Thank you so much for watching the Petrochemical Weekly Update. If you have any questions about anything you saw this week, just ask me. I am Robert Sawchuk, and I will see you next time.